Welcome, ladies and gents. You know what time it is. Time for a new episode of the Passive Income Attorney Podcast. If you're ready to get started on your passive investing journey, pause this right now and go to escapethebillable.com to download our Billables to Abundance Bible, a field guide to getting started with passive investing. Okay, the stock market roller coaster is in full swing. The line is long and it is wide open. How can you get off this ride and still invest in a stable future for you and your family? There are a number of ways, but it all starts with education. And congratulations, you're already taking that first step by listening to this podcast. Learning and networking will give you the confidence that you need to step off the Wall Street roller coaster and stroll over to Main Street where the grass is green and the girls are pretty. Listen and talk to people like our guest of honor, Mo Bina. He's an expert in analyzing financial markets and commercial real estate and is also a good friend of mine. Mo is a respected author and the managing principal and founder of High Rise Capital, a boutique commercial real estate investment company. He's an experienced investor in alternative assets, private money lending, and in various real estate sectors such as residential, multifamily, senior living, office, and industrial real estate. All right, without further ado, on with the show.
This is the Passive Income Attorney Podcast, where you'll discover the secrets and strategies of the ultra wealthy on how they build streams of passive income to give them the freedom we all want. Attorney Seth Bradley will help you end the cycle of trading your time for money so you can make money while you sleep. Start living the good life on your own terms. Now, here's your host, Seth Bradley.
Mo, what's going on, brother? Welcome to the show.
Seth, I'm doing well. How are you doing?
Doing great, man. Doing great. Really excited to have you on today. Mo's my really good friend, so it's awesome to have a recorded conversation about passive income and real estate and all things that related to that. So I'm really excited to have you on today, man.
Oh, I'm excited to be on as well too, Seth. Thank you for having me on. It's I know we have a lot of conversations and now we're actually for the first time going to record it. So we'll see how it goes.
Yep, let's do it, man. Well, let's just start out. What's your story? Tell us what's your story. Feel free to brag a little bit. Start wherever you want.
Well, I've been passive investing for some time now, and I've passive invested in a number of opportunities across different asset classes, primarily in commercial real estate. Although I've done some, outside of commercial real estate as well too. And, as I've been doing that, I mean, I hate to say it's been a journey, but in a way it kind of has been because, you start out a little bit kind of like unsure, like you don't know too many other people doing this and investing in commercial real estate or especially syndicated commercial real estate. And you kind of like at times like, am I doing the right thing? I don't know too many other people doing. Everyone else is investing in the stock market. Why am I doing that? And it kind of, when you kind of buck the trend and, you kind of gravitate away from the rest of the herd, you kind of may second guess yourself. And in the beginning, I certainly did, but, I look back on it now and I feel so relieved that, there's this whole world out there of alternative assets and alternative investments that so many people don't know about. And obviously, shows like yours, are out there trying to bring attention to it.
Yeah, for sure, man. So how did you kind of discover alternative assets? I mean, where did you, find out about those things that most people just know to invest in their 401k and stocks and bonds and mutual funds and whatever their financial advisor says to do, they do it. I mean, what kind of brought you to that place?
Yeah, it kind of started, when I finished grad school and, I graduated way back in the day, when I was in grad school at Stanford, that was in the heyday of the dot-com boom. And I remember like everybody at school thought that they were going to leave campus and they were going to go start an internet company and they were going to make millions and then they would retire by the time they were 23 and a half. And so, and this was back in 98, 99. And, I kind of went through that because once I finished school and, I had a job, I made a little bit of money and I invested in tech stocks. And of course, it wasn't even a year later when the whole thing just kind of crashed. And it was funny because at that time, I would go read the Wall Street Journal. I thought I was, a real academic type and I knew what I was doing. And, I remember reading about the new economy, and I remember reading about how, well, you can't use traditional methods of valuation to value these internet startups and these internet companies because it's the new economy. And of course that all crashed and burned. And, we look back on it now and we're like, well, no, there's basic ways of valuing businesses and valuing assets, and those things never change. If you don't make money, you don't make money. There's no other way of explaining it. Although people who are buying Tesla stock these days, maybe they may disagree with that.
That's the one that I was thinking of. Yeah.
And, but anyway, that was about 20 years ago or so. And so that kind of planted the seed with me, but it wasn't until some number of years after that, whereby, the next time around, where the global financial crisis happened in 2008 and 2009, where I really woke up. And when I saw back then, and for the listeners that were around then and or at least paying attention to what was going on, may remember Hank Paulson, and Hank Paulson, who was the head of the Treasury, if I remember right. He had come out and he went in front of Congress and had said that we need $700 billion to save Wall Street, and or else the whole system was going to collapse. And I remember wondering to myself, well, what kind of system needs to be rescued? And how is $700 billion going to solve it? Because if the system is broken, then why don't we fix the system? But, maybe that's just me. And I always want to fix and tinker with things and always question. But that was pretty much the end of it. At that point, I realized, I'm just tired of this whole, investing in Wall Street and giving them my money and seeing the volatility, and all the things that come with that, being disconnected from what your investments are doing, not having a say in how some C-level executive or some hedge fund manager, what they're doing with your money. And so I just everything kind of culminated for me. And so that was 10, 12 years ago. And then from then on, it's just, I've really always just kind of looked at alternative investments, and it's just really kind of been something that I enjoy more. It requires a little bit more homework, but it's, for me, it's a lot more fulfilling, and it's a lot more empowering as well too, to know that I control my investments to a certain extent, but a lot more and being a lot more connected to them as well too, especially on the real estate side.
Yeah. I think you named a couple of the really big things there. And one is the volatility. I mean, it's hard to imagine right now, because everything is just bullish, right? Everything's going up. You hear about Tesla, you hear about all these different stocks that are just through the roof. But it's not that long ago when it wasn't like that. And it's not always going to be like that. It's always going to be up and down compared to something like real estate or alternative assets, where it's just a lot more consistent. And the other thing that I heard was, control. And we don't always have control in commercial real estate when we're investing passively, so to speak, but we do have control of where we place that money. And we have control over speaking to the people that we want to invest with, and have a pretty good idea of what we're investing in when we vet the properties in the deal. So there's a lot more control over what we're investing in.
Exactly. Yeah. You said it spot on. That's what I mean by control. It's not that we're making day-to-day decisions about anything. And ultimately, I don't want to make day-to-day decisions because I have enough day-to-day decisions that I have to make. And I'm sure a lot of other people do too. But it's the control, in the sense that I can control if there's a particular geographic market I like, if there's a particular asset type that I like, if there's a particular, let's say, deal sponsor or management team that I like, if there's a particular type of investment strategy that I like. And I can combine all of these factors and find deals that fit, the criteria. And that's the control that I have,
Yeah, for sure. And so let's go into some of those passive investments that you started out with. You have one of the most diverse passive investment portfolios that I know. So maybe walk us through some of those.
Yeah. So I've invested in multifamily. I've invested in senior housing as well. I've invested in office. I kind of wish I didn't do that one. I've also invested in industrial. I've done value add. I've also done, ground up development. So I've done a mixture of all these things. I've done different geographic markets. And so, what we just kind of mentioned, just a couple of minutes ago, I mean, you can build essentially your own portfolio, if you want to call it, where you're taking different investment strategies and you're overlaying them with different geographic markets and different sponsors or different management teams, and you essentially build your own portfolio, and the different pieces kind of come together, because if you're using different investment strategies, then more than likely you're taking different risks as well too.
Yeah, I mean that's the beautiful part about it is you can diversify, right? I mean, you just said it. You went over your portfolio. I mean, you went into industrial and office and multifamily and all these different things that you can invest in. I think you've invested in even ATMs before. I mean, there's just so many things you can diversify into within those passive syndications. So it's pretty awesome you're able to do that, and also across markets too.
Yeah, yeah, definitely. It's uh, and it's people starting out may feel a little overwhelmed if they've never done this type of passive investing before, and there's no reason I would say that they should be overwhelmed by it, because if you take the time to really kind of understand what you're doing, and sometimes it may take a matter of weeks or it may take months, but you get to a point where you're like, okay, I feel comfortable now. I'm gonna jump in and I'm going to invest, because I like this particular type of asset class, or let's say that I like this particular area, whether it be one that's local to me, or maybe it's not. Maybe it's in an area or geographic market that is benefiting from the migration trends that we're seeing right now in our nation, and so maybe that somehow resonates with people. Um, and so you just have to find something that you like and that resonates with you, and then just take action.
Yeah, yeah. I mean, you've got to educate yourself, right? I mean, you've got to get comfortable with reading the documents, looking at different deals, and kind of immersing yourself into it to a certain extent. But at some point, you've got to pull the trigger and just do it. And I always talk about that first time you send out that $50,000 or 75,000 or $100,000 wire. It's a little bit nerve wracking, right? That that first time, you're like, did somebody just take my money? No, you invested it pretty wisely, hopefully. So pretty
Yeah.
interesting hearing that from you. Um, Maybe talk to us about investing passively versus actively, because you're now on the active side. You do a lot of active investing on the general partnership side. So, how did you make that transition? And what would you say to listeners who are thinking about either investing passively or actively? Actively, they don't know which way they want to go yet.
Yeah, that's a good question. It's they're two completely different beasts, and I some people start off, investing actively, and they never even have invested passively ever. And there are, of course, people that who have passively invested, and then they kind of transition to doing that on an active level. And for me, it was, of course, starting out passively and then kind of transitioning. And a lot of that happened because of just really getting immersed into it. And when I first got into commercial real estate, and when I look back on it now, there were a lot of things that I wish I knew then that I know now. But that kind of like growth, I guess, then that desire to want to continue on and to become even more involved, and to actually understand the other side of it, and to be involved on the other side. And by the other side, I mean on the active side,
Mm-hmm.
of how these deals are done, and how they're put together. And also having that mindset of, being a passive investor, looking at deals passively, and understanding what passive investors want to see and what their concerns are, and also understanding risks as well too, because that was something that I think probably the biggest thing in, from beginning to where I am, when I first started to where I am now, I think the biggest thing is probably risks, and understanding risks a lot better, and being able to identify risks, and then at the same time being able to take them and qualitatively like digest those risks, and then thinking, okay, is this something that I'm comfortable with, and is this something that I want to move forward with? And that's something that I think is probably the hardest part, maybe, is for people first starting out, is because everything looks risky when you just don't have the knowledge. But I think once you start to get it, then the level of, you feel more comfortable because you feel more certain about certain things. And of course, we're talking about investments. There's always going to be risk. You can't eliminate every risk, but it's all about a matter of identifying them and understanding if these risks that are there, you're comfortable with.
Yeah, and I think that's a common misconception with real estate, that it's inherently risky. I mean, any investment is risky. Real estate's risky. Stocks are risky. But I think the riskiest part is just having one stream of income. That's what I preach. It's, if you only have one stream of income, that's the riskiest position you can be in. So you've got to create these alternative asset streams for yourself.
Yeah, yeah, exactly. And that was a major thing for me. Let's say in my journey, was, reading Cash Flow Quadrant from Robert Kiyosaki, and understanding that, the whole paradigm of how people are told to invest is you put away a bunch of money in a 401k. You're going to go and primarily invest or entirely invest in securities, mutual funds, stocks, bonds, whatever, ETFs, because most employers or the custodians that most employers are using, they only allow these types of investments. And then you're going to build this huge nest egg of paper assets, which provide very little, if any, tax benefits. And then you're going to go to retire one day when you're, I don't know, 60, 65, maybe older. And then you're going to slowly start to liquidate all these assets. And who knows where, when you take into consideration volatility is going to be, are you going to feel comfortable even retiring? I mean, look at people that maybe wanted to retire, when they're maybe in their early or mid 60s and they were ready to retire. What did they do, when the last global financial crisis hit and the stock market tanked? And I know you can kind of look at that situation, and it's a little different than what's happened just recently last year, because it took several years for the stock market to recover to where the pre-crash levels were. And of course, what happened last year is that it's more than recovered in less than a year. So again, you just never know, right? And that volatility aspect can affect you pretty dramatically. And then you go to liquidate, and then now you're living off, you're liquidating on a monthly basis these assets in order to pay your expenses and to cover your costs. Well, why not just try and acquire assets that generate income versus assets that you have to sell and liquidate? So it's a completely different line of thinking, and it was something that I never thought of until I read Cash Flow Quadrant and read some of Robert Kiyosaki's works. And that was a real game changer for me when I stumbled upon that years ago.
Yeah, it's just something we're not taught that in school. And we should read Rich Dad Poor Dad when we're probably in middle school. I mean, you should be exposed to those types of ideas when you're young, rather than like you and I, we read it way too late, right? I mean, we should have read it when we were 10 years old. But it changes your mindset, and it gets you out of that, like, okay, work 9 to 5 till you're 65 mindset, because that's just an old school way of thinking. And when you really break it down like you just did, it doesn't make any sense. It just makes zero sense.
Yeah. And he says it all the time. He talks about how there's no financial education, and he talks about how the system doesn't want you to have it. And he's right, because they want you to do what they want you to do. And yeah, there's some people in the herd that kind of stray away, from the rest of the herd, maybe like you and I. And, we stumble upon, the Holy Grail, if you want to call it. And, we end up doing something different. But what's interesting is when you look at the alternative asset space, it's continuing to grow. When you look at the amount of investable capital worldwide, it's increasing year by year. And a lot of that has to do with, what's going on, in the markets. For example, like the stock market is having difficulty, or I shouldn't say hasn't been having difficulty, but there's no yield anywhere, or it's very hard to find it. And so pension funds and sovereign wealth funds and financial institutions and so forth, they're looking for yield somewhere, just because of how low rates are, because of monetary policy by many of the central banks. And so more and more of them are turning to alternative assets to get the returns that they're looking for. And of course, they're trying to do that at the same time without having to take any excessive risk.
Yeah, for sure, man. Let's switch gears a little bit. I've heard about this empowered investor methodology you put together. I'd really like you to dive into that and talk about that and tell us what is that?
Yeah, so it's kind of a reflection of kind of, the experiences that I went through and talking to people, over the years when they would ask like, oh, well, how are you investing in commercial real estate, and what is a syndication and, alternative assets? And, and of course, for some time now, the word alternative maybe kind of has it's almost developing, a negative perception or connotation to it, where they think that it's some type of like something on the fringe,
Yeah.
and I would say that it's the complete opposite, because like I just mentioned, when you look at the global investable capital, more and more of it is going into alternative assets. And maybe one day me or someone else will come up with a better term or name for alternative. But at this point, it's basically anything that's non-stock market or paper related,
Right.
And I should be careful when I say paper, because, you can invest in notes, for example, like note investing, and that's paper,
Yeah.
but by paper, I mean specifically like investing in stocks and bonds and ETFs. But the 5-step method, I call the empowered investor method. And it basically speaks to of this 5-step process. And it's actually based on what I call the 5 E's. So the first E is ethos. The second E is educate. The third E is evaluate. The fourth one is execute. And then the fifth step is empower. And so the 5-step process, is kind of like a roadmap for someone who either has been investing or has no idea how to invest either in commercial or alternative assets. And it's all built on a foundation of the first E, which is ethos, which is your mindset and your thinking and your beliefs. And we've already kind of mentioned, the beliefs and the thoughts that people have, or some of them at least, when they think that they need to invest like everyone else, investing in the same vehicles, investing in the same types of retirement plans, investing in the same, asset classes. And when you look at the alternative universe, it's so much bigger, than investing in stocks and bonds. I mean, we're talking about investing in crypto. We're talking about investing in commercial real estate, investing in fine wine and collectibles, and investing in liquor stores if you want, investing in mobile home parks. So when you think about alternative, it's actually so much bigger than, in terms of variety and depth, than the traditional world of investments that most people have been geared to invest in. And so the 5 E's is basically a kind of a roadmap to get people from that first step of changing their mindset, changing their beliefs. And then it culminates into this like empowered step where they feel like they're in control. And they are. And also not just in control of the direction, but also more connected to their investments as well too. Because one of the themes of the whole empowered investor methodology is the fact that I think more and more people, they don't like the fact of how their money's being used. And I know I'm going on a little bit, but I'll tie this back in with what happened in the last global financial crisis, with the Occupy movement. Do you remember there were all these people that they went and they were hitching up tents and parks and corners and all this other stuff, and they were trying to buck the system. Well, and it was funny because even a lot of like professionals at the time that I knew were upset, but within a matter of weeks or months, they were putting their money back in 401ks and investing in Wall Street. And it's kind of like, well, I thought you disliked that whole system,
Right.
But they were back, partaking in that system. And I think something important that people should probably realize is that instead of trying to rework a broken system, just go make a new system.
Mm-hmm.
We're not going to fix Wall Street. We're not going to fix, this, the fact that, I mean, we can even talk about GameStop, right? I mean, that's a perfect example about how, to a large extent, a lot of it is rigged against, the average person.
Right.
And how, in essence, we're not nearly as powerful, even if we're acting in mass or in a large group compared to like the forces at play. And so why try and change it? I think it should be changed, but I could just concentrate on something else, on other asset classes and invest in other ways. And part of the empowered step is being connected to your investments, investing in like commercial real estate, something that you can drive and go see. You can go and touch it. You can go see the lives that it's affected, hopefully improved, I should say. And, or it's provided some societal benefit. So that's what I mean by this connectedness and this empowered feeling that people then get, because now their money is being used not just to build wealth, but also to improve communities and lives.
Yeah, definitely, man. I love the ethos and educate portions of that, because if you get your mindset and the education pieces together, it just kind of, it opens your mind up to all those different things that you mentioned about, investing in mobile home parks or apartment buildings or crypto or all these different things that are outside of the traditional assets that we all know about. And it just allows us to just start thinking on a different level about how we can diversify into different types of things. And I love what you said about trying to, why do we try to fix the system? I mean, you can see from the last few months about trying to take it over and try to re-rig the game in our favor, and it just doesn't work. You can't do it. We've been doing it the wrong way for so long. Why fix it? Let's create our own economy and invest in different types of things.
Yeah, totally. I totally agree. It's if Wall Street didn't get I don't even know how many hundreds of billions of dollars or more a year in money that people pour into the stock market, and that pour into mutual funds and fund managers collecting fees regardless of how they perform. And if people withdrew from that system, and I'm not saying that system shouldn't be there, because really it's all about companies that go from being private to then being public are raising capital because they want to take that capital and they want to do something with it. But in a lot of cases, the system has gone to the point where it's like, you look at valuations of certain stocks, and it almost kind of like reminds me of the .com days again. And I don't want to name any particular stocks, but I think people know which ones they are. And it's like, well, why do I want to become part of that? Because like you said, you can withdraw from that system and participate in other systems. And this is one of the things that I know that, for example, people that are heavily involved in crypto and blockchain, because these are all decentralized systems, right? And these decentralized systems, are outside of the traditional, let's say, banking or the traditional system with financial institutions. And so, and that resonates with a lot of people. It also allows people to invest in things that don't have, that can't be expanded or inflated, let's say. So if you have, let's say, like a Bitcoin that can, at most, will ever have 21 million coins, in essence, it's very deflationary, right? There's always going to be scarcity there just by virtue of the fact that there's a finite supply. Mm-hmm. And I was explaining to somebody just recently, like, when you think about it, not even gold is finite. Well, I mean, I guess it is finite because it's only the gold that exists on our planet. But, if you're willing to spend more and more money in terms of extraction and production costs, you can always go and find more gold, at least as far as we know of at this point. But something like Bitcoin, which will never have any more than 21 million, if that's known, then that can't be changed. And so you already know what that finite supply is. Who knows? I mean, maybe one day, someone will be able to dig, miles in the ground, which I know they do in parts of the world, like in South Africa, and they can extract gold, where it's like 120 degrees or hotter, because they're so far deep down in, mines and so forth. But, can someone truly say how much gold is known in the world that hasn't been mined? I mean,
right.
Maybe someone tried to estimate it, but again, it comes back to Bitcoin, where it's like a known supply. And I know I've gone off on a tangent on the whole Bitcoin thing, but again, it's part of that whole universe. And people look at that and they think, oh, well, it's, I remember a couple of years back, like people were saying, oh, this is the tulip mania again. And,
oh, yeah.
And I was like, but yeah, okay, the price run up to $20,000 in late 2017 was abnormal, let's say. That was definitely a lot of speculation, but I told people that you got to really understand that there's a bigger story behind all this. Don't let the speculation, throw you off. And now you look at Bitcoin has more than doubled that, in less than 3 years.
Yeah, pretty insane, man. So let's say we've graduated from the school of the empowered investor methodology. We're looking at, let's bring it back into kind of your traditional types of deals. When you're looking at a potential deal, what are some of those things you look for? Because you've looked at a lot of different types of deals. So I guess we can kind of keep it general, but generally we look at the market, the deal, and sponsors. So what are some of the specific things within those three items that you look for?
Yeah, one of them obviously is going to definitely be, when you're looking at the people involved, and there's that element of, the sponsor, the management team, what experience they have, what is their track record. And it doesn't always have to be in real estate. I mean, yeah, you want them to be real estate, you want someone or one or more people on the team. But I think a good team also has a mix of people as well, too. And I think it's also good that, that there are people who have been involved and they've been at least through someone on the team that's been through one market downturn. I think that's important. So, they've been through a recession, And so they know kind of what that pain feels like. And hopefully they also know what needs to be done when you do go through something like that. Because remember, we're talking about investing in assets that, we're holding on to for years at a time. And so it's not like stock market investing, obviously, where you jump in and you can jump out, literally like seconds or minutes later if you think like you made a wrong mistake. And I think a lot of commercial real estate investors, they understand that. And so I think they always tread cautiously, but definitely understanding who the management team is and understanding the particulars of the deal and understanding the market and why they're getting into it. For me, a big thing is understanding, the underlying fundamentals and the drivers. So for example, whether it be in multifamily or let's say senior housing or industrial, what are the drivers there? Because if you're investing with a long-term trend and that is in your favor, then, that's hopefully will bode well. Then it's a matter of making sure you've looked at the sponsor team, the geographic market checks off, and the actual specifics of the property. They look good as well too. And as part of all this, it's identifying risks. And I think that's something that people don't do enough of. It's easy to kind of see the upside, but I don't think too many people understand or try and evaluate what all the downsides are. And I think that's a very big thing that I've learned myself, is being able to look at a deal and seeing all the potential risks and figure out like which of the risks have been mitigated for, and how they've been mitigated and in what way have they been mitigated. And also understanding, do all those risks taken collectively, do I feel comfortable with them? No one's going to sit around and do a decision tree analysis and assign probabilities to all these various risks, because that's impossible. That works in school and probably in academia, where you can try and estimate risks and give a probability to it all and do a whole decision tree analysis, like I remember doing in college. But in the real world, it really is about qualitative. No one really knows, but you have to identify the risks first and then kind of understand, do they sit well with you? Do they align with what you're looking to accomplish and what your investment goals are?
Yeah. And we're talking about risk-adjusted returns, right? I mean, if there's more risk, let's say if it's a development deal, then do those returns that they're promising, do those meet that risk? Are they worth taking that additional risk for those additional returns? And you've kind of got to just balance those things to figure it out.
Yeah. And it's really just a qualitative analysis. Like I said, you're not going to be able to assign numbers, and no one should. I should make that clear. I don't know anybody who does. And
if anybody did, it would be you, Mo.
No, and I don't even want to do that. It's really just a matter of a lot of it comes down to experience, and I think a feel. Like, does it feel right based on what you know and what you've seen? And if it feels right, because all the things seem to line up, and it feels like the team and the people involved on the team have been able to mitigate for risks, or as many of them as possible. And again, like you said earlier, like all investments carry risks. There's no way around that. All investments carry risk, because risk just means there's uncertainty. And some risks, they actually turn out in your favor, right? We think of risks as being negatives, but they can actually be positives, right? So there may have been some type of risk, and the risk may actually have turned out favorable in your, and when I say favorable, I mean in the favor of the investor and the deal sponsor, right?
Right.
We always tend to think of risk as something that's bad, but sometimes it works in our favor, and that's important to understand, that there's threats and opportunities, I guess. Some risks, can be utilized in terms of in a good way, in a positive way, and then sometimes they work out negatively. And it's always the negative ones that people try and focus in on. And it's important to also understand that, maybe if you have a risk that could turn out to be a positive, then maybe what you want to do is you want to try and, figure out a way of making sure that likelihood of that event can more than likely happen, versus mitigating for that, right? So when I say mitigate, I'm talking about mitigating for the negative outcomes, not the positive outcomes.
Right. Yeah. We don't want to mitigate the positive outcomes.
For sure.
All right, man. Before we jump into the Freedom 4, what's one last golden nugget for our listeners?
Golden nugget. Wow.
Very general.
So very general
with it.
Wow. Well, I think I would say to the listeners, if they have never invested in alternative assets, and especially in commercial real estate, I would say that I would highly recommend that they do. And I'll give a few reasons for that. You know, right now, I think more so than at any other time in our history, I think that the middle class, especially professionals and people who have, careers and that have, incomes and they're doing fairly well. I think that now versus any other time in our history, you know, the middle class is, I think, on the verge of really shrinking even more so. You know, it's been diminishing over a number of decades now, largely because of globalization, right? And so now, people in lower skilled jobs are competing against people in other countries. And so that shrunk the middle class, especially manufacturing jobs to quite an extent. But, over the next 5 to 10 years, there's a lot of other things taking place. For example, like automation, and that's going to affect professional level positions as well. And, there's also other things going on, like when you look at the monetary and fiscal policies, when you look at what central bankers are doing and how they've telegraphed, or they basically have stated, as recently as when I was reading the FOMC minutes from December of last year, they basically said that they're going to continue, flooding the system with liquidity and making, borrowing rates as cheap as possible. And we know that one of the things that their policies have done is they've increased asset prices. So those people that own assets, okay, they've experienced, let's say, some that wealth effect from that. So their wealth has increased, but there have been a large segment of the population where there's this growing wealth and income gaps that are taking place. And I think now, even more so than ever, people in the middle class, which is going to continue to shrink and get smaller, I believe, it's important that they make the right decisions with their investable capital. And so I'm largely talking to professional level people, because even some of their jobs too will be affected by automation and things like AI and other trends that are taking place. And even more reason, not just to make sure you're making right decisions, but to have other streams of income as a safety blanket, right? As to make sure you have a little bit of a cushion. So if, the next recession happens and you get laid off, or maybe your job is affected by automation, people don't even understand that, for example, like a lot of articles now and a lot of like things in newsprint is actually generated by AI. It's not a writer or an author that's actually writing a lot of this stuff now. It's actually all or mostly written by, AI and algorithms. And so, journalism, which was already like, without getting into fake news, but, journalism has been affected by AI, and most people would have said, well, that's a professional level position, right? And so, more and more jobs are going to be affected. And I think it's even more important that people understand that if they have investable capital, they need to make the right decisions. And I know I'm giving a long explanation on the to the question, but I would also throw in as well too, also look at what fiscal policies are taking place. And this is not a commentary to be political in any way, but just look at the trillions of dollars that we now embark on in deficit spending annually. And that is a lot of money. That is a lot of money, and someone has to pay for it. So it's either going to be paid by way of inflation, so the loss of your purchasing power. It's going to be paid by way of the debt increasing. And so either way, everyone gets affected. Inflation affects everyone. It affects people on the lower end of the scale, let's say, disproportionately, but it affects everyone. So the loss of your purchasing power, and hopefully if you own assets, then, the appreciation you feel in your assets will be positively affected by that increasing of the wealth gap. But I think the next 5 to 10 years are going to be very, very tumultuous, and it's important that people invest prudently and kind of take that more empowered position with what they do.
Yeah, you've got to take control of it and do your best to create your own economy, so to speak. I hear a lot of people talk about that, so that you just have more control and you're not just dependent on that one single income stream, and you're not, worried about who's going to be the next president, because it's not going to affect you as much because you're already taking control of your life and your finances.
Exactly.
Yeah. All right, man, let's jump into the Freedom 4.
It's time for the Freedom 4.
What's the
Okay.
best thing you do to keep your mind and body healthy?
Yeah, eat right and exercise. So it's important, to oxygenate the blood, right? And it helps with the thinking, and it helps with your health. And several times a week, it's important to really exercise and to really eat well too. So one of the things that I've done, over the last year or so is really cut down, on sugar, for example. And I think taking control of your body and your health, I think, is a very important thing. And I think it also kind of brings that empowered sense too, where it's you don't feel like you're lethargic, you don't feel like you're constantly tired. Nobody likes to have a few pounds, on them. And when you take control of your health and your body, then it just kind of you feel like you want to take control of other things in your life too. Everything just has a cascading effect.
Yeah, for sure. It's definitely like a holistic type of thing. I did the Whole30 last month, and you cut out alcohol and sugar and, dairy and pretty
Oh,
much
wow.
everything. So it's the first couple of weeks are rough. And then after that, though, you feel great. I mean, your mind is clear, you're sleeping better. You don't really miss those foods anymore. It's crazy how that just kind of changes you. You just have to work your way through the hard part.
Yeah, definitely. Like intermittent fasting. I try not to eat late at night. Most days I will not have breakfast at all. So, the first meal of the day isn't till well into the late morning hours. If not, sometimes even lunch is the first time I'll eat, other than maybe some water or some other or tea or something in the morning. And, that seems to help tremendously as well too. And there's a lot of health benefits to intermittent fasting. And, that's something that I've done. And I've read so many good things about it. It gives your digestive system, kind of a break. The very act of eating actually creates free radicals in your body, which, ages you and has other health effects as well. So, and that's even if you eat well, it just the very fact of your digestive system working creates free radicals. And so that was very eye-opening when I first found that out. So just something, maybe another tidbit, I guess, for people to kind of look into if they've never heard of intermittent fasting and the health benefits of it.
Yeah, for sure. I've heard a lot of good benefits from that. I do it naturally. I don't really eat breakfast. I just eat a lunch and then a dinner, and then I go like 16 hours without eating again. So
Yeah, and that's actually supposed to be really good for your blood sugar as well too, because it kind of gives your blood sugar is able to kind of stabilize for a longer period. I even read our ancestors never ate 3 meals a day, so there's an evolutionary reason for it as well.
makes sense. Makes sense. In an alternative universe where you weren't involved in your current businesses, what would you be doing?
Wow. In an alternative universe, well, I'd probably be about 6'7", and I'd probably be playing in the NBA. I would be averaging about 26 points a game, 10 rebounds, and maybe about 7 or 8 assists.
I love that, man. I think we have the same dream. I held on to that even through high school, even though I was 5'10", but I love it. Where were you at 5 years ago, and where do you see yourself 5 years from now?
Wow, 5 years ago, I felt like I felt like I was still trying to kind of figure things out, and I still am. And I think 5 years ago, it was still trying to better understand, alternative investments, trying to better understand kind of where I fit into all that, in terms of my investment thesis, and really trying to understand the bigger picture and the trends. And so I embarked on this kind of book reading, I don't know if you want to call it journey, but there was a few years there where I just read dozens and dozens of books about all different types of subjects, and I took the time to really kind of broaden my horizon, let's say. And I read books on all different types of topics, from geopolitics to health, to how our monetary system works, and it really kind of gave me a bigger picture view. And it gave me an appreciation for how so many things are interrelated and interconnected. And back then I didn't really quite see it or understand it. And I know there's a simplicity to our human mind, and that kind of also falls in line with kind of the first step of my method of the ethos is also, and also actually say the first two steps, where it's about understanding that there are a lot of things that are interconnected and there are trends that take place, and understanding, where those trends are going. And I'll give a good example, like in commercial real estate, understanding, what are the trends in multifamily? What are the trends in senior housing and some of these other asset classes? Because like we mentioned before, you're investing for the long term. And when you're investing for assets you're going to hold anywhere from 5 to 7 or more years, you want to know what those trends are and whether or not you're investing, in line and parallel to what those trends are. And so I always like to look at, the bigger picture, and then I kind of hone down on more of kind of a granular micro level. And 5 years ago, I didn't feel like I had it, I should say. And now I feel like I have a much better appreciation for it. And I'm always trying to learn more and always trying to piece together other things and see whether or not they're pieces that fit into the puzzle, or maybe they don't. And then when you realize they don't, you just kind of discard it, and then you just kind of move on. And that's kind of like one of the reasons why I've written some of the ebooks that I have, was to kind of pass along some of that knowledge, and sharing that with others.
5 years from now.
5 years from now. Thank you. I forgot about that part. Wow. I don't want to sound cliche, but hopefully having made a difference, helped other investors kind of realize the benefits of alternative assets and alternative investing. I would say that one of the things that I really dislike, if it hasn't already come out so far, is I really dislike, systems that take advantage of people. And largely, Wall Street has turned into one of those systems. And so helping people realize, that they don't have to participate in that system, or at the very least, maybe they can minimize their involvement. And so it's almost like hacking into the matrix, right? You do it on your terms, not instead of always being plugged into it. Maybe you want to invest in the stock market or have that to be a certain part of your portfolio. And that works very well. And I think you can be very successful. But I think also understanding and building a larger portfolio that includes at least some alternative investments, especially in commercial real estate, and combining that with stocks and other things, I think is a better way to go, and helping people come to that realization. And if I can be a part of that movement like you are, and helping people get there, then, that's what I love more than anything else.
I love it, man. Love it. Last but not least, how has passive income made your life better?
Like I said, just that extra sense of having income that comes, from another source other than maybe what you do, or if you're maybe, there are some passive investors out there that literally make a living off of all their passive income. And so, but they have multiple streams of income, and it's not an easy thing to do by far. I will attest to that. I'm certainly not there. But when you have multiple streams of income coming in from your various investments, you have a sense of like, oh, okay, well, if something were to affect your livelihood in some way, if you have an illness or an injury, what would you do? What most people end up doing is they have to liquidate assets, right? But instead of liquidating, if you had passive income coming in, maybe it covers some or most of your expenses, and you're able to kind of weather the storm, let's say. And, I think that type of like comfort, especially moving forward, like I said, over the next 5 to 10 years, I think that's going to be even more important for people to have multiple income sources and to actually be able to rely on them, or hopefully they won't have to rely on them, but if they ever had to, then, just having that sense of security that, I'm okay, I'll be okay. I can weather the storm and I can get past it.
Yeah. Love that answer, man. Love it. Let's wrap it up, brother. Where can our listeners find out more about you, Mo?
Yeah. My website is High Rise Capital. It's HIGH with a hyphen, and Rise, RISC, capital.com. And I have a free ebook. So if anyone's interested, they can sign up for my monthly newsletter and my ebook. It's called More Doors, More Profits. And I've just recently finished writing 2 more, one on investing in senior housing and also one on investing in industrial. So these are 3 great asset classes that I like. And these aren't the only ones I should say that I like in commercial real estate, but these are definitely 3 that I've been focusing on. And these are 3 that I'm basically trying to bring attention to other investors out there.
That's awesome, man. I highly encourage everyone to look up those downloads and download those books. There's so much great content in there. I mean, he should be selling these books, not giving them away for free. So make sure you download a copy of those. Mo, thanks again for coming on today, man. Really appreciate it.
Yeah, thank you, man. It was a pleasure being on. Thank you so much, and thank you for helping spread the word to all your listeners out there about the tremendous opportunities that exist in alternative assets.
All right. Always a pleasure talking finance and investments with Mo. If you want to expand your knowledge about global financial trends, real estate, and just about anything else on this planet, talk to Mo. He has something intelligent to say about it. It'll also make you realize how much you don't know. Major key, rewind and go back through the empowered investor methodology, and it all starts with education and awareness. To learn more, I invite you all to join Epic, our Esquire Passive Investor Club, by going to passiveincomeattorney.com and clicking join the club. Until next time, my friends, enjoy the journey.
Thank you for listening to the Passive Income Attorney Podcast with Seth Bradley. Do you want more ideas on how to generate multiple streams of passive income? Then jump over to passiveincomeattorney.com for show notes and resources. Then apply for the private Facebook community by searching for the Passive Income Attorney on Facebook. And we'll see you on the next episode.